All right, let's go quickly now with chapter 10 in the beginning. Chapter 10 was dealing with the property, plant, and equipment, which is the long-term assets available for the company. Those are the company that's they can be tangible, they can be intangible, using for the long period of time, relatively expensive used in operation of the company to help create a value to the customers, in other terms, revenue. So how we gonna measure? First was the measuring. How we gonna measure the cost of these long-term assets? The basic principle is we're gonna use the cost principle, which is we're gonna get all the costs which happen to bring the assets ready for the intended use or for intended purposes. And we're gonna deduct any discounts if they're available for us. So we have land improvement. We saw last time what's included in the land: purchase price, brokerage commission, closing costs, property taxes, cost of grading, cleaning, demolishing, removing unwanted building until the land is ready to be used for intended use. Land is not amortized. Land improvement, on the other hand, that's something different, not including lighting, signs, fences, paving, sprinkler system, landscaping. Those are amortizable. In both cases, for the land and for the land improvement, we're going to debit long-term asset account land for the land improvements for the land improvements, and we're going to create either cash, either accounts payable if we haven't paid yet. For the buildings, we have two options for the building. One option is to construct a building, or we to build a building. The second option is we to purchase the building. If we construct the building, that means we have to accumulate all the costs for the architectural fee, building permit, contractor charges, payment for materials, labor, overhead, everything, until the building is ready for the intended use. For purchasing, if you're purchasing existing building, then we have to include the purchase price plus any legal fees that we have to pay, plus any repair renovation cost that we need to bring again the building for the intended use. Once the building is ready to be used for the intended use, then we can stop accumulating the cost and we're going to come up with the cost of the building. So for the equipment, we're going to include the purchase price, transportation charges, insurance in transit, provincial taxes. Don't forget the provincial taxes. Any taxes which are refundable from the government, we're not going to include it. GST is refundable. We are subject to a GST tax credit. We're not going to include the GST. Purchase commission, installation cost, testing, those are included. On the category of the equipment, we have vehicles, furniture, computer, some other items which are available into that category equipment. And we have one big category, which is leasehold improvements for the old building, which are not owned by the company, but are used by the company. Those buildings are if the building is on the list, then we might including some costs which are related to painting, renovation, installation, special equipment. Again, the point is we to bring the building for the intended use. How are we going to recover the cost? We're going to amortize the cost over the term of the lease, which including the renewal of the option, or the useful life of the lease, whichever is shorter. We saw the example when we purchase a basket, means more than one asset, with the market value higher, individual market higher than the combined purchase price for those assets. Then we're going to use proportional method. And then we allocate the price that we paid based on that proportion of each asset. And then we're going to record the assets as a long-term assets. Betterment and repairs. Repairs, what I want you to remember is repair is always expense, where the betterment will be debited to the asset. And it's because increasing the capacity or efficiency of the asset or extending the useful life of the asset. The ethical issue, there will be always ethical issue with betterments, repairs, coming up with the fair market value, what's the market value, what to expense, what to capitalize. So one day you as accountants or you as managers, you have to make those decisions. Which one will be the capitalize, which one will be expense, how much to capitalize, how much to expense, what will be the useful life, what will be the fair market value of the asset. You have to come up with those. Once we have the asset, now we're going to start using the asset for intended use. Once we start using the asset, he's going to bring us benefits. Now, once the asset brings the benefit, we have to show some expenses. That will be the amortization. So what we're going to do, we slowly going to start allocating the cost of the asset over the useful life of the asset because we're using the asset to generate revenue. This allocation of the cost of the asset over the useful life of the asset is called depreciation or amortization, depends on the terminology. For this course, we're going to use both terms, amortization and depreciation. How are we going to measure it? First, we're going to get the cost, means cost, purchase price plus legal fee plus all the other single elements if we're having building. If we're having equipment, we have to get the purchase price plus insurance plus shipping plus everything. Then we're going to estimate the useful life, how long we're going to use the asset. And then we're going to estimate the residual or also called salvage value. You can see the both terms, residual and salvage value, used in the textbook. And that will be expected cash value that we can get at the end of the useful life of the asset. So how much we're going to amortize? We're going to amortize only the cost less the residual value. So basically, amount that we paid less the amount that we can get as a cash. What's left, we can amortize it. How are we going to amortize it? Different methods. Now, based on the assets, we have a different treatment and different expenses. For the land, again, we never amortize land. Land improvement, we have amortization, depreciation. Building, machinery, equipment, furniture, fixtures, again, amortization, depreciation. For natural resources, we're going to have amortization or depletion. Intangible assets will be amortization, and for the goodwill, that will be impairment loss. On the amortization methods, we saw last time we have three common methods. One will be straight line method, which allocates equal amount over the useful life of the asset. Second one is unit of production, which allocates specific amount based on the usage of the asset. And the last one is the declining balance, which allocates percentage of the original cost of the asset and tends to amortize great amount in the beginning and less amount at the end. Again, to estimate how much we have to amortize, we need the cost, we need the estimated residual value, and we're going to come up with amortizable cost. For the straight line method, whatever amortizable cost, we're going to divide it by the number of the years that we're planning to use the asset, and that's going to give us equal amount for each of the years that we're using the asset over the useful life. Again, amortization expense is not going to change. It's going to stay the same. Accumulated amortization is going to start increasing every period with the amount, with the same amount, until you reach the amortizable amount. On the asset book value, it's going to start declining until we reach the residual value or the amount of cash that we can get at the end of the useful life of the asset. How it's going to be presented on the balance sheet, we're going to have two accounts. One is the asset account, and then we're going to have a companion account, which is called accumulated amortization, which is contra account to the asset account. They always go together. On one account, it's going to say the original cost of the asset. On the accumulated amortization, we're going to show how much is the accumulated amortization up to the end of the period that we use the asset. And the difference always going to give us the balance left to amortize. Unit of production method. Again, we're going to find out what's the amortizable amount. Then we're going to see how we're going to use the asset. Based on what allocation we're going to use the asset. Is it number of units produced or kilometers driven or anything that we can produce with the asset? In this case, we're using the kilometers driven. So once we have amortizable amount, we're going to divide it by the total kilometers that we're planning to drive the asset over the useful life of the asset. And we're going to get the amortization per single unit of usage. And then the next thing that we need, information about how many kilometers the asset was used every year. And then we're going to apply the amount that we get. So every time we're going to apply 15 cents per kilometer, what's going to drive the amortization expense will be the amount of kilometers that the asset has been driven. And as you can see, again, the objective is we to amortize the asset over the useful life over 5 years, or the kilometers that the asset was driven. And at the end, the net amount to stay on the balance sheet, which will be the original cost less accumulated amortization, to be the residual value that we expected to get as a cash at the end of the life of the asset. Double declining method. For double declining method, we're going to use a percentage based on the number of years that we're going to use the asset. So one will be your nominator, number of the years will be your denominator. That means one is 100, number of the years, over how many years you're going to use that entire 100%, and you're going to come up with the percentage per year. In this case, if we're using the asset for 5 years, that means 20% per year. Then we're going to increase it by doubling the rate. Double means whatever the percentage we get as a calculation 1 divided by number of years, we're going to multiply it by 2, and that's going to give us a new percentage. And we're going to start multiplying that percentage to the original cost until we reach residual value. So we're going to start applying that percentage again until we reach the total amount that we can amortize, which is 60,000, which is the amount of original cost of the asset less the amount that we expect to get as a cash at the end of the useful life of the asset or residual value. Once we get that number, we're going to see how much we have to amortize. Once the accumulated amortizations reach 60,000, we stop calculating. If that happened in the middle of the period, we would ignore the percentage and we manually going to adjust the number to match the total amortizable amount that we can amortize over the useful life. So again, accumulated amortization cannot exceed 60,000, because if that happens, then we're not going to have residual value left at $5,000. Which method for what purpose we can use? I mean, depends on the asset, depends on the industry, depends on your personal choice. Straight line method is going to give you the same amount over the life of the asset. Unit of production is going to give you number which is related to the usage of the asset, direct usage of the asset. And the double declining method is going to give you a very high amortization at the beginning of the life of the asset and slowly, slowly, slowly decreasing. All three methods, you have to understand we're going to get the same objective. We're going to amortize $60,000, so amortizable amount which we calculated in the beginning of our calculation. We cannot amortize anything more. How is going to be comparison as on the chart? Straight line method will be just straight line. With the unit of production, we're going to fluctuate again based on the actual usage of the asset. Double declining will be very high in the beginning and slowly, slowly decreasing during the years. For the income tax purposes, income tax, you always is tricky. For those of you who are going to continue with the accounting, they're going to see Canada Revenue doesn't accept the amortization methods which are used in accounting. But they give specific instruction what kind of amortization percentage can be used on the specific items or specific assets. All the assets are grouped in classes. Each class has a different rules for amortization, transferring the cost of the asset over the useful life of the asset. In Canada Revenue reality, that's called capital cost allowance. So again, Canada Revenue doesn't recognize the amortization depreciation from the accounting system. So for the Canada Revenue purposes, we have to come up with new calculation, which is called calculation of capital cost allowance. Capital cost allowance, there are different rules. And there's a similarity between the double declining method and capital cost allowance method. What's going to happen if we have a partial year? If we have a partial year, we have to have a partial amortization. Again, don't forget, partial year doesn't change the fact that we have to amortize the asset over 5 years if we have calculated 5 years. So that means if the amortization starts on April 1st, the last year amortization is going to finish March 31st. We have to have 6 full years, regardless when the year of the amortization starts. It can start on June 1st, then and the last year is going to finish on May 31st. We have to have a full year if we're using straight line method. So having that in mind means that the first year we're going to have a partial year, last year we're going to have partial year, in the middle we're going to have full years. How are we going to get the partial year? Luckily for us, every year has equal amount of months, 12. So once we get the amortization for the entire year, we're going to divide it by 12, and we're going to see how much is per month. The other option that you have, you can go over, let's say the asset useful life is 5 years, times 12, you have 60 months. Get the cost of the asset, amortizable cost of the asset, divided by the total number of months, 60. I'm gonna get amortization per month. And then see how many months during the year I have used this asset. 6 months, 6 times amortization per month is gonna give you the amortization expense. What's gonna happen if we don't purchase the asset on the first of the month, but we purchase it somewhere in the midpoint of the month? Well, it depends. There are few approaches. One approach is if you purchase the assets between the first of the month and 50th of the month, you start accumulated amortization on the 50th of the month. If you, sorry, you start amortization on the beginning of the month. If you acquire the asset between 50th at the end of the month, then you're just leaving the first month and start accumulating amortization from the next full month. Obviously, since you're going to purchase asset in different period of time, different months of the year, those two methods, if you apply consistently, they're going to offset each other eventually, and there will be no benefits or no disadvantages of using this method. What I personally use, I personally always using the same approach, this approach. On the month that I purchase the asset, I'm not recording amortization expense. I always record amortization expense from the next month. Again, that's my personal preference. You as an accountant, you're going to have power to set up your own policy for amortization. Once you follow the policy consistently, everything will be fine. Can we change the useful life of the asset? Yes, we can. What's going to make it change? If we do a betterment or if the new estimation comes available. Then what we're going to do? We just going to move forward. We're not going to go backwards and start changing the amortization schedule. We're just going to implement the new numbers and we're going to move forward. What that means? We're going to get the cost. We're going to deduct the accumulated amortization up to the point of the changes available. We're going to deduct new residual value if there's a changes in the residual value. And we're going to divide it, the amount on the remaining useful life that we estimating that asset to last. If we have a betterment, we're going to add the betterment to that amount, and we're going to see how much we have to amortize going forward. We're never going to go back and revise the past year. What's going to happen if we fully amortize the asset? You have the end of the 5th year, we amortize the asset. Based on the example, we amortize 60,000, 5,000 sitting as a residual value. But the asset is still useful. Can we still using the asset? Absolutely. Then what's going to happen? No amortization expense anymore. Company can continue using the asset. It's going to generate revenue, but there'll be no transferring the cost of the asset as a amortization expense. Eventually, this asset is going to come to the end. So we have to see what we're going to do and how we're going to deal if we dispose this property, plant, and equipment, or the long-term asset. We have different options here. First option is we use the asset worn out, it cannot be used anymore. Or the asset become obsolete. Or the asset no longer is useful for the business. Then we can see, can we sell or exchange or discard the asset? Now, to record the disposal of this asset at the end of the life of the asset, there are a few rules that we have to apply. First rule is to bring the amortization up to date. So, for example, if we decide to dispose the asset on January 31st, 2026, first thing that we have to do is to see was the most likely if the year end is December 31st, 2025, the amortization was updated. Then we have to show the amortization expense for 1 month, that the month that we use the asset in January, and put it as a accumulated amortization. Then we have to start doing some calculation. And what will be the calculation? Calculation will be, we're going to check how much is the original cost of the asset. Then we're going to check how much is the accumulated amortization amount up to this point. The difference gonna show us unamortized amount, or the amount that we're waiting to amortize and transfer as a cost to expenses. We're gonna see how much cash we get, and based on the cash we get, either the amount that left for amortization will be higher than the cash, either the cash will be higher than that amount. That's going to determine are we going to have a gain or loss of the sale of the asset. So what we're going to do, we're going to remove the asset first. Once we sell the asset, or once we discard the asset, once we move the asset and no longer use it, we have to remove it out of our balance sheet. So we're going to create the asset account. Since the asset is gone, we cannot keep any accumulated amortization related to that asset. So we have to debit that account with the accumulated amortization for the asset to eliminate the accumulated amortization account. Then we're going to see did we get any cash or we didn't get any cash, and difference will be gain or loss on the sale or discard of the asset. So let's see first example. We discard the asset. What that means is we amortize the asset up to the amortizable amount. Let's say our cost of the asset was 60,000. We accumulated amortization is 60,000. Asset is fully amortized. So what we have to do, we have to just remove the asset from the books first. Since the asset is long-term asset and sitting on the debit side on the balance sheet, we have to credit it with the same amount. So that's why we're creating machinery with 60,000. Accumulated amortization, as we said, is a companion account or contra account to the asset that has always credit balance. And since we reached the accumulated amortization for the 60,000, which is sitting as a credit on the accumulated amortization, we have to debit that account and we eliminate the amortization. So no more amortization. Amortization is set to 0. Asset account called machinery will be set to 0. And we're done. That's first option when we amortize completely the asset to the, or accumulated amortization reach amortizable amount. Second option, asset is discarded before it's fully amortized. So once the asset is gone, then we have to credit the asset account. Since the asset is gone, we cannot have the accumulated amortization related to that asset. We're debiting accumulated amortization. And then we will have to see which one is higher. Most likely in this case, if we not fully amortize the asset, obviously accumulated amortization in other term, amortization expense that we accumulated over the years will be less than the original cost. That means we're losing money. We're going to show it as a loss, and we're going to deduct our income at that purpose. The next option is, what if we decide to sell the asset? So for the selling of the asset, I'm going to use this example, and I'm going to move it to Excel spreadsheet. So we can do it together on the Excel spreadsheet. This one is kind of important, so that's why I prefer to use Excel spreadsheet to show you how exactly it's going to go. I'm still going to use the Excel spreadsheet from the last time. So that's going to keep adding for the Excel spreadsheet from the last time, and then I'm going to post it and be available for you. Just give me a second and I'm going to start sharing my screen. Stop sharing this one and move to the next sharing, which is the Excel spreadsheet. So we have the question here. On September 30th, 2023, company sold the Sell surplus office furniture for $50,000. Now, the original cost was $100,000, was purchased on January 1st, 2020. The asset was amortized over 10 years on the straight line method, no residual value. Annual amortization expense is $10,000. 2020 minus 2022. So let's see how this is gonna go. First thing first, original cost. We have to do the calculation, which calculation we're gonna get from here. I can easily copy this and move it to the new worksheet, which is right here. And now I start changing the numbers just to adjust it to our reality here. First thing first, original cost is 100,000. Residual value, that's one more zero I need here to make it 100,000, 100,000. Residual value, they saying no residual value, so the residual value is zero. So they have amortizable cost is 100,000. They have to amortize it over 10 years on the straight line method. That give us 10 years amortization per year. Per month 12, so that means 8, 33, 33 per month. First, annual amortization expense is 10,000. So what that means to us is if we have to bring the T accounts, I'm going to bring the T accounts. Again, I'm going to use this part here to make it faster, and I'm going to post it right here. So what I have is I have furnitures. And my beginning balance is zero. Then I purchase on January 1st, I purchase 100,000. Did I get too many zeros this time? Let's move it. 100,000. Amortization, I amortize it. Year one, year two only. Nothing else. Actually, I need the years, but I don't need this one or this one. Okay. So the first year I have 10,000. 1, 2, 3. And the second year I have 10,000. No more for third, fourth, and that's why I am a year two. So at this point, my net value is 80,000. That's how much I still have to amortize over the remaining periods. But in year three, I decide to sell the asset. When I'm selling the asset September 30th in year three. So what I have to do first? First rule was to update. Let's make those one bigger. Actually, rather than do that, let's format this. First thing I have to update my amortization schedule. To update for the amortization expense. And to reflect accumulated amortization. So I'm using the asset from January. This annual amortization expense already been recorded. I'm not worried about this. But what I'm worried is, did I use the asset from January to September 30th in year three? Well, most likely I did, because I'm selling the asset on September 30th. So up to September 30th, I have to show my amortization. So let's do it. Debit amortization expense. And we're gonna debit the amount of, this case, the amount will be for 9 months. We have 9 months time $833.33. And then we're gonna credit accumulated amortization account for the same amount. So my debit will be equal to 9 times this amount, 7,500. Credit will be exactly the same amount. Not here, it's gonna be right here. So I have my accumulated amortization, which I have to transfer here, 7,500. So my accumulated amortization up to this point is 27. So what's happened here? My beginning balance, let's say, is, let's move it here, 0, ending balance. Then I have the purchase of 100,000. And then I sold it. On September 30th, year 3, I sell in the asset. So my ending balance has to go 0 because I don't have the asset anymore. I sold it. It's gone. So first thing, let's update the furnitures. This asset has to be gone. So 100,000 gone. That will be the first thing that we have to do. September 30th, the first entry to date. Second one is to account for the sale. So let's start. Credit, furnitures. And the furniture's credit will be $100,000. Gone. If the furnitures are gone, accumulated amortization, which is related to the furnitures, also has to disappear. This balance has to come up with 0. So the only way to make this balance 0 is if I credit this account with the same amount that's sitting on the debit. And the debit I have at this point 27,500. So the same amount has to come as a debit. Okay, so that will be my second entry. That will be debit accumulated amortization furnitures with 27,500. So far, so good. Now let's see what else we have to do. Let's format those cells and I have to change it all the time. Next thing, let's check, did we get something? We get the company sell the furniture for 50,000. So we get cash. If we sell it, we get cash, debit cash, and we get 50,000 cash. Not 58, only 50,000. Now we have to see where we are. Where is my debit? Where is my credit? I'm selling furnitures, which I pay 100,000. I use them for 2 years and 9 months. I amortize 27,000. I get 50,000 cash. So what's happened here? My total that amortization plus the cash I get is 77,500. So I'm short on the debit side. How much I'm short on the debit side? That will be 100,000 minus 27,500 minus 50,000. I'm short $22,500. Since it's on the debit side, I have only one option here. That will be debit loss on sale of furnitures in this case. So I pay $100,000 cash. I get $50,000 cash. I amortize 27,500 only from the remaining 50. So the remaining 250, 22,500 is my loss. I'm losing from not using the asset and don't having opportunity to amortize this asset and show it as expenses. But now I have it as a loss, which directly reducing my income. So we are good. Does this make sense?
Sorry, could you clarify, why exactly you're debiting the amortization and crediting the expense or the furniture in that case?
Okay. Once I buy furnitures, what do we have to do? Debit furnitures, correct?
Yes, that's right.
When I sell the furnitures, do I have the furnitures?
No, you don't.
No. But if I keep this account with the 100,000 debit, that means I have the furnitures, correct?
Yeah,
What do I have to do to bring this account to zero?
credit the 100,000.
And I'm creating 100,000,
Oh, okay. Okay, that makes sense. Thank you.
right? First thing first, I'm creating the 100,000. Second, in this account, I'm showing only this account only and only exists because I have these furnitures. Because I want to keep accumulated amortization to see how much I'm amortizing of these furnitures.
Sorry, Ivan. Monica had a question. She was asking if
Let
we,
me let me explain this one, and then I'm gonna go back to the question. So accumulated amortization exists only and only because of the furnitures, correct?
yeah,
If I don't have the furnitures, can I have account sitting on the balance sheet, accumulated amortization
no,
furnitures?
you cannot.
No, I cannot. But this account at this point, before I sell the asset, has a credit balance of 27. How can I eliminate that balance to bring it to zero? By debiting the same balance, correct?
Yeah,
So that's what I'm doing. I'm debiting the same balance, accumulated amortization. So once I do the blue one, I'm eliminating the amortization. Amortization, accumulated amortization furnitures is zero. Once I credit the furnitures, account furnitures is zero. Next thing that I'm gonna see is, did I get cash? In this case, we get $50,000 cash. Okay, cash. We get the cash. And the last thing that left is the cash that we get plus the accumulated amortization equal to the money that we pay for the asset, 100,000. No, it's not. We are missing 22,500. What's that for us? That's a loss. We're losing the opportunity to use the asset and to having the accumulated amortization. For that reason, that's purely loss of sale of the furniture. Now let's go and see now the question from Monica, because I told you when I'm doing this, I'm not monitoring the chat. So if we would have sold it for 72,500, there will be not loss. That is correct. But let's say it. Okay, so now let's do this, Monica. Let's play with it. This is scenario one, right? This is scenario one. Let's see scenario two. Scenario two will be, we're still working with the same numbers. We're still getting 9 times 833.33. We're getting the amortization. Now, accumulated amortization gone. Option two will be, as you said, let's get the $72,500 cash. My original cost of the asset is equal to 100,000. So what's happened in this case? I amortize the asset for 27,500. I get cash 72,500. So in total, 100, which is exactly equal to the cost of the asset. So what's happened in reality? I pay $100,000 for the furniture. I use them for 2 years and 9 months. I amortize 27,500, and the other 72,500 I receive it as a cash. In this case, I have no loss, no gain, nothing. Let's see another scenario. Another scenario, obviously, if we get more than 72,500 cash. I still have to show the amortization for 9 months. 9 times 8333, 7,500. My accumulated amortization not gonna change, 27,500. But now let's say the cash, now I'm getting cash instead of 72,500, I'm getting 80,000. 80,000 cash for something that I paid 100,000. So what's happening now? My debit is 107,500. My credit is only 100. So I need credit. I make profit. So what will be that for me? Credit. That will be gain on sale of furnitures. Make sense? And that will be 7,005. Or it's going to be equal to this one. No, this one plus this one minus that one. 7,500, that will be my gain in this case. Make sense? So again, this can happen. You have examples in your life. For example, you buying, let's say, what you buy, vacuum cleaner. You spend $500 on vacuum cleaner. You use it for 5 years. You estimated that you're going to use it for 5 years. That means you're going to amortize every year. It's going to cost you $100. You use it for 4 years, and on the fourth year, you sell it for $200. Do you make gain or losing money? Go, Monica. I know you can get this. Again, you bought the vacuum cleaner for $500. You're planning to use it for 5 years or $100 per year. You're selling it, you use it for 4 years. In the beginning of the fourth year, you sell it for $200. Are you making profit? Are you making gain or are you losing money? Any suggestions? Are you guys with me here?
Yeah, I'm with you, Ivan, but like I'm having the same problem like Monica. I just work better when I see like the written instruction instead of verbal instruction. I think others might have that as well.
The point is, in life, you're not always going to have Excel spreadsheet in front of you, and you're not going to have a pen and pencil to do it. So we have $500 for the vacuum machine, right? Vacuum cleaning machine. I'm planning to use it for 5 years. That means I have to amortize. It's gonna transfer $100 every year. I use
Okay,
it for use it for 4 years. How much I amortize at this point?
400.
And I'm selling it for 200.
That's a gain.
If I use it for 2 years and I sell it for 200.
No, that's a loss. Sorry, I just made a mental error.
Okay, make sense? So now process it slowly and start increasing the speed of the calculation. Okay, use the simple numbers. Use the very small numbers. 100. Work with 100. 100 over 10 years. How much is amortization per year?
10,
10. Use it for 9 years. How much amortization you accumulated?
90,
90. And you're selling it for $20. Are you making gain or loss? How is 90 plus 20?
it's a gain.
Gain 10. Make sense? What if I sell it? What if I use it for 7 years and I sell it for 20? Loss. How much is my loss? 10. Okay. So here calculation is 100 over 10 years. It's gonna give you $10 per year. Now the question is, how many years are you using it? I'm using it 7 years. 7 times 10, 70. Cash, I'm getting cash, $20. How much in total I get? This is my amortization. This is my cash. Amortization in cash is only 90, but I pay 100 in the beginning, so I'm losing 10. If I use it for 9 years, then that changes everything. Then amortization in cash is 110. I pay 100, that means I'm making, now my gain is $10. Make sense? I'm gonna leave those numbers here. The next thing, what you have to do is change the number in the yellow cell. Once you change the number in the yellow cell, that's gonna give you the gain. That will be here gain or loss. Actually, the gain loss that will be here total, and the gain and loss will be, let's put it here, gain slash loss, and that will be the gain and loss will be this one minus this one. As long as it's positive, is gain. Once become, let's say you're using 7 months, then become loss. And then you can play with the numbers here, changing these numbers or changing these numbers, whatever you want to change. This one, the same thing. That will be your amortization here. That will be your cash. That will be your total. And this will be a gain versus loss. Total will be 400. In this case, will be 400 minus 500. That will be original cost. And that also will be original cost. That will be number of years and amortization per year. Same terminology is going to keep here. Years, amortization per year. Make sense? Are you guys with me?
Yeah, I'm with you.
Okay, I'm gonna save it this and I'm gonna post it for you later. That will be sale of property pawn equipment.
So a quick question, Ivan. I emailed you about like the how to copy and paste like questions from like Excel. I mean like from the homework into Excel. Like I
After
tried
after
doing.
the class. After the
Oh,
class.
okay.
Let's discuss those one after the lecture. Okay, questions with this selling of the asset and calculating gain or loss. Let's move to the slides then and finish these slides. So on the slides, waiting for the slides to show up on your screen as well. Let me try to share again. Here we go. First thing, we are updating the amortization schedule, showing the accumulated amortization expense for the furniture for 7,500, accumulated amortization. Then, once we do that, we're gonna do the, again, you don't have to do this calculation. You don't have to do the, if you wanna do it, but you don't have to. What you have to do is, remember, follow the logic. Once the furniture is gone, clear the furniture account, bring it to zero, or whatever the original cost of the furniture is, gone. Accumulated amortization, up to this point, gone. They're making mistake here. It's 7,000, 20,000, that's 27,500. So that's 27,500. It's not 37,500. Anyway, the and after that, once you get rid, see how much cash you're getting. The difference is your accumulate, your gain or loss. That's how simple you can remember it. That's when we selling the asset. The last option that we have is if we exchange the asset with another asset. Now we have two scenarios. First scenario is we exchanging the asset with exactly the same asset. That means there is no commercial substance. What's the commercial substance? Commercial substance is related to the future cash flow. Are they the same or similar to what we have? If they're exactly the same and similar to what we have, that's considered no commercial substance. If they're not the same, that means there's a commercial substance. Now, if there's no commercial substance, the new asset is recorded at the book value of the old asset, and there's no gain and loss. That's how you should remember it. If there's a commercial substance, if I'm exchanging vacuum cleaner for a truck, now the future cash flow for the truck will be significantly different than the vacuum cleaner. Then there's a commercial substance. So what do you have to do? The new asset has to be recorded at the fair market value. Old assets is going to be clear from the account, debit the old asset. We're going to clear the accumulated amortization, and we're going to see, do we have any gain and loss on the old asset? And that's how we do it. So let's see this question here. Now, assuming that the truck with a cost of 42,000 and accumulated amortization 30,000 is exchanged for the new truck with the fair market value of 53. The trade-in allowance is $8,000. So that means we get in cash $8,000. And the cash for $45,000, we're paying only $45,000. We're not paying 53, we're paying for only 45. What that means to us? Do you understand this idea with the trade-in allowance 8,000?
I'm still falls a bit foggy with the concept.
So
Can you
watch this.
clarify?
I have to pay 53,000, correct?
Yeah.
But they're saying, I'm going to give you allowance 8,000.
Okay.
How
So
much
like
I have to
allowance
pay?
means
I
so
have
like
to pay now
allowance.
only 45.
Oh, okay. Okay,
Make
that
sense?
yeah, that makes sense. Yeah.
So I'm I'm getting something that's worth 53, but I'm paying only 45.
Yeah. Yeah. I can understand that.
Make sense?
Yeah.
So what's happening in this case? In this case, happening this. First, the old asset gone. 42,000 is credit to the old truck. That's gone.
Okay.
Correct? Accumulated amortization, which is related to this truck, also gone. I'm debiting accumulated amortization 33. That's gone.
Sorry, did you
And
say
so,
33 or 30?
sorry, 30, 30, 30, 30,
Oh,
30,
okay. Good.
30, 30. So at this point, I'm losing 12, correct?
Yeah.
I'm losing 12. Are you guys with me?
Yeah, 30,000 plus
Minus
12,000, 42.
12,000. I'm losing 12,000. Clearly. I'm getting the new truck for 53, correct? And I'm paying only 45. How much I'm making on this one? You're getting something that is $53,000, but you're paying only 45. How much you getting? Do you understand this? Do you have any benefits? You, for example, I'm going to buy a milk for $5, but I'm only paying $3. What's my gain?
$2?
$2. Same thing here. I'm buying new truck for $53, $53,000, but I'm paying only $45,000. How much
That's
am I get?
8,000.
$8,000. Make sense? So I'm from the purchasing the new truck and paying less, I'm gaining 8,000. But for the getting out of the old one and removing the amortization, I'm losing 12. 12 minus 8 is how much?
4,000.
4,000. So I'm showing loss of exchange of the asset, $4,000. From where the $4,000 came? 12,000 from the old asset loss, 8,000 gain from the new asset, in total 4,000 loss. Does that make sense?
I think I mean, yeah, up to a degree, yeah.
That's how you're getting this loss of $4,000 only. Is this make sense for everybody? Show me thumbs or show me yes, we understand, or tell me no, we don't understand. Explain again. Tell me something.
Sorry, I'm a bit lost on like where you got like the, so I understand the 4,000, like, the loss of 4,000, it's from the 12,000, but like that part is a bit foggy in like terms of, uh, you know,
So,
yeah,
okay, let's go with the first sentence. Cost of $42,000. Accumulated amortization 30,000. So what we're doing? We're doing
12,000.
we're doing debit accumulated amortization 30,000.
Yeah.
Credit old truck $42,000.
Yeah.
How much is the difference? $12,000 on the debit side. Correct?
Yeah.
Debit
Yeah.
side is loss.
Yeah.
So on the old truck, we're losing $12,000 clearly.
Okay.
Now let's see the new truck. I'm getting the new truck for 53, debit 53, but I'm paying only 45. So now I'm on the credit side, I need 8,000 to balance my entry, correct?
Yeah, that's right.
So when I add the 8,000 out of 12, that's 4. So technically,
Oh,
I'm
okay.
losing 12, but I'm gaining 8. So my overall loss is 4.
Oh, okay. That makes sense. Thank you.
Does that make sense for everybody? Yes, that's correct. Let's see the last one, the natural resources. What we're going to have with the natural resources. With the natural resources, those are tangible assets now, but they're also called wasting assets. Why? Because once we use it, it's gone. And the way we're using things, we're mostly wasting the things. So what will be that? That will be iron ore, coal, oil, gas, lumber. One is gone, is gone. Oil, for example, once we extract it from the ground, there's no new oil that's gonna come. After maybe 250 million years, maybe we can find a new oil, but not on the short term. So what we're gonna do with the accounting for the natural resources? We're gonna get the, let's see, we're estimating that the cost of the oil that we found oil, like a new kind of bed of oil under the ground, and the cost is $300,000 to extract it and do it. We estimating that this oil contains 10,000 barrels. So what that means? For every barrel that we extracting, we have to amortize $30 per barrel. So if 3,000 barrels are extracted, we have to show amortization expense for that year with $90,000. And that's going to keep going until we take out all the oil. Now, the future removal inside restoration cost, that's something that we have to consider and we have to put it as a cost on our assets. What that means is we have to estimate those costs and obviously amortize those costs over the life of the assets as well. So those increasing significantly because the company must restore the site after remove everything to the original conditions. They might have to do some future removal and site restoration, so they have to estimate those liability if they feel that there's some liability coming there. And company must describe those assets retirement obligation in the notes of financial statements. So the readers of the financial statements clearly understand how much obligation this company has for the something that they have to pay in the future. That's with the natural resources. Let's see goodwill. Goodwill, you're going to talk about goodwill for those of you who are going to continue with accounting. There's a full course on the goodwill that's called Advanced Financial Reporting. There you're going to see what the goodwill is, how you get the goodwill. But before we go there, let's talk about first the intangible assets. The intangible assets in goodwill, they don't have a physical form. For the assets, those are patents, copyrights, trademarks, franchises, leaseholds, and goodwill is part of this. Amortization is computed for the leasehold over the estimated useful life of the lease. For the intangible assets, they can be directly written off against the intangible asset amount. Now, the tricky part is here. In the intangible assets, we don't have accumulated amortization account. We're just showing the expense, nothing else. So how this gonna work? Let's say we have a patent. We buy patents. We want to run a Tim Horton franchise, so we have to buy the patent. We buy patent which I have the exclusive rights for 20 years. For 20 years, I can take the benefits of having a Tim Hortons and running the Tim Hortons. I'm paying $2 million to get the patent. And expected useful life is 5 years. So what they have to do? 2 million divided by 5, $400,000 every year. At the end of the year, I'm going to show amortization expense, $400,000, and I'm going to subtract it directly from the patent. There will be no accumulated amortization in this case. I'm going to subtract it directly from the patent. So the patent account always going to show me the exactly remaining balance that I have to amortize in this case. Which are those specific intangible assets? Those are copyrights, which have exclusive rights to reproduce, sell software, books, musical composition, and other works of art. Trademarks and brand names, which is distinctive identification of product and services. Franchises and licenses, which is the privileges granted to sell a product or services according with specific conditions. And the leasehold, those one is the arising from the prepayments made to secure use of the asset, and those are amortized over the life of the asset. The other specific intangible is the goodwill. Now, what is goodwill? Goodwill, the very simple way to explain the goodwill will be, I want to buy, so watch this. I want to get hands on Middle East market. But they not let new entrants on the market. So the only way I to get on that market is to buy company that already have market share on the Middle East market. I'm checking the companies and I'm seeing that there's a company for sale. When I run the net assets, means assets minus the liability, net assets are for $50,000. But because I need that market share so bad, I'm willing to pay $70,000. So what I'm doing, I'm paying $20,000 premium. The net assets of the company are $50,000. I'm paying $70,000. $70,000 that I'm paying over the net assets of the company is called goodwill. So the goodwill is the purchase price that the company pay over the market value of the net assets of another company. It's a very unique asset and it's created only and only when one company acquire another company. That's the only way you to generate a goodwill. There's no other way. So why I'm acquiring this company? Because I want customer. I want market share on the Middle East market. End of the story. The other reason that I'm acquiring company is because they have a software, which is very unique. I want it. Or because they have a good location. Or because they have efficient operations. Or because I want to achieve monopoly on the market. For any reason, you can acquire assets for any reason. This is the example. Let's say the purchase price, the company willing to pay $10 million for something that worth $8 million. So they're paying $2 million in excess. For what? They know for what. Maybe they have something that the company doesn't know. Or because they're chasing the clients of the company, clients list or anything, whatever they want. I'm not gonna test you on the goodwill, because for those of you who are going to continue with accounting, you're going to have the entire subject on this. And then you're going to talk about the goodwill and the loss of the goodwill and how the impairment on the goodwill happened and everything like that. The last thing is the comparison between International Financial Reporting Standard and Accounting Standard for the private enterprises. As I said the previous times, it will be hard for me to make a comparison with you, since you only know the accounting standard for the private prices. You have no idea what's going on with the International Financial Reporting Standards. So those of you who's going to continue with the intermediate part of the accounting, they're going to make this comparison later in the chapters when they start taking intermediate financial reportings. And that's going to be the end of this chapter 10.